US GDP forecasts have been super high over the last little bit. And you've got people like Chamath Palihapitiya calling for 6% GDP growth in the US. This might give you the belief that the US is firing on all cylinders, that things are just rocking, that it must be the absolute best place to be, and business is thriving. I mean, legitimately, it's the largest economy in the world in nominal terms, second largest in the world on PPP terms. And so 6% growth is like really impressive. Only China does numbers like that, and they haven't been doing those numbers in the last little bit. So this seems on the surface like it is super impressive. So is that true? Is that what you're seeing? Is this, maybe part of an AI boom? Is AI giving us a ton of productivity? I mean, you see unemployment figures being a little bit shaky in terms of job creation, while at the same time seeing boosts in GDP. It would fit, right? This is AI. I mean, what are we talking about here? I'm going to give you maybe a little bit of a more nuanced flavor on this, and hopefully shed some light on some of the things that are going on, so that you can have a better understanding, both from an investing standpoint as well as just sort of a geopolitical outlook standpoint. So let's dive in and talk about that right now. Before we do, if you haven't already, please hit the subscribe button. If you're new here, welcome. I am Michael. Thank you for being here on our channel. I very much appreciate your support. And if you're interested in the things that we take care of here, which is international corporate structuring, so we help people to optimize their global tax for themselves as well as their business, set up global corporate structures for you, do banking, payment processing, deal with where are all your employees and your customers and your suppliers, and making all these things work in a holistic overall strategy that is most efficient for you in ways that you just cannot achieve domestically. If that's interesting to you, then please reach out to us. You can book a call with me, calendly.com/Michael-Rosmer, link in the description below, or send a message through offshorecitizen.net. Okay, so talking about GDP. I don't like GDP as a measure. I think it is, I don't want to say it's a gameable statistic, but it's a little bit deceptive statistic. And to dive into understanding why that is partially requires looking at how they measure GDP. Now, Elon Musk has a famous little thing that he talks about two people paying each other to eat some crap, and they've both eaten crap, and they've created a bunch of GDP. That is true, but I don't think that is the principal critique that I have in this particular situation. The critiques that I would have start with the fact that, and this is not a problem with the measure of GDP, by the way, so let me just be clear. I'm not saying that the metric of how they measure it shouldn't be measured this way, but what I'm saying is it causes some deceptiveness when you're trying to measure year-over-year figures. Okay, that's the sort of main thing that I want to call attention to. And so the first is that imports get deducted from GDP. Okay, very, very important to understand this. So what does that mean? If your imports drop, then your GDP goes up. Okay, if imports rise, GDP goes down. All the other things being equal, of course, right? So why is that a problem? Well, right now, what we're seeing is the Trump administration is saying, look, we've got these amazing GDP growth figures. Like, how can this not be us rocking? We are amazing. They've never had growth like this in decades. The Trump administration is amazing. Surely we are great. And it's like, okay, well, let's maybe dig into that a little bit more to see how much this is claiming credit for things that maybe one should not claim too much credit for, or don't exactly indicate what it is that you're thinking. And the first is this whole thing about imports being deducted, right? So what do you think happens when you start applying these tariffs? Oh, that's right, we decrease imports, right? So suddenly you're in a situation where, because you're importing less, that means you're gonna have higher GDP. Like, it just naturally boosts your GDP. Everything else kept equal. And so that's sort of deceptive because all things were equal, right? So this is, I think, the first thing that you need to understand is tariffs naturally have had this effect. Not really for the greatest of reasons, but simply that's the way it goes. The second thing that relates to this is last year was basically the worst year in a very long time for the US dollar. So if you track the DXY, you will see it performed very poorly. Well, what does that do? That makes US dollars less valuable abroad. So what does that do to imports? Oh yeah, that also drives imports down, right? Because they just can't afford to buy as much stuff with the same number of dollars. And so both of these effects are not particularly great for the US, but they have taken the effect of boosting GDP. So not to say that all other things aren't a factor, but these things we need to consider. The next thing that I think is overlooked, and I want to dive into this one a little bit because it's worth understanding this from the standpoint of company earnings, okay? So in the Big Beautiful Bill, they changed some things, and I actually think the change was really, really excellent, okay? And that is they made capital expenditures able to be entirely written off in the year that those expenditures were made. So what normally happens? What normally happens is, let's just take, for example, a vehicle. So I'll talk about in Canada, but various different countries have their own versions of this. So in Canada, you buy a car and you basically write the car off over 5 years. I'm slightly oversimplifying it, but that's the basic idea. And the principle here is, obviously, if I make a capital expense, the value of that thing doesn't go to zero in year one. So of course, why should I get to write it off entirely in year one? I want to kind of write it off over the lifetime of the vehicle. And the idea is, okay, if I have a commercial vehicle, it's being operated enough that 5 years is probably like a reasonable lifespan for it. And so this kind of makes sense. Not irrational at all, okay? But it does play into what it is that people can afford to spend on capital purchases because of the fact that they're going to be taxed even though they don't have that money. So this is a discrepancy effectively between your profit and loss, we're talking about from a tax standpoint, and your cash flow statement, right? So your cash flow has gone negative, but your profits still show a gain, and you're taxed on the profits, not on the cash flow, right? That's the sort of idea. Well, they changed that, and this arguably has had a bunch to do with the AI investment boom, okay? So let's just take a look at Google. Google is in 2026 saying they're investing $105 billion in the AI infrastructure build-out. I mean, that's a lot of money, right? A lot of money. This is one company. So we're talking about over $500 billion a year. I think I heard somewhere there's about 600 billion per year for this year being put into an AI build out. And part of the reason why that makes a lot of sense for Google is because they get 100% write-off in the year that they do it. So the effect that this has is that from the standpoint of taxes, your operating profits improve because you get this deduction against the taxes, right? So just to kind of, so that you understand that, normally I would have to pay, let's just say 21% corporate tax. We'll just like make a very simple number. 21% corporate tax, it's actually not that because of, there's global operations and then there's different states and state taxes and all this sort of thing. But let's just say corporate tax rate in the US, 21%. So I make $100 billion, I'm gonna have a $21 billion tax bill, right? That means that the after-tax income available to shareholders, which kind of translates down into your earnings per share and hence your price earnings ratio, is going to be about $79 billion in the example that I just gave there, okay? Cool. Well, now if I come and I say, oh, guess what? You get to write off that entire capital expense in the year that it is made. Now you maybe just crushed that tax entirely to zero. And so because of the fact that there's sort of this mismatch between financial accounting and tax accounting, you're gonna say, oh, wow, well, we have way less income tax that we have to pay. And because we have way less income tax that we have to pay, and let's just say you eliminated the $21 billion of income tax, then you're in a situation where you actually are now earning $100 billion. Again, this is like super simple, rough numbers. Obviously, it's going to be complicated because you have to consider depreciation, and you have to consider interest, and you have to consider amortization, and you have to, look at different, anyway, the whole point is your tax bill in the immediate is going down. And that's great. Right? That's great. Now the shareholders make more money, the price earnings ratio goes down, the valuation seems lower, and therefore, boom, this company should be able to trade at a higher price, right? So it seems like everybody wins. Well, the problem with that is that in the long run, they still have to pay the tax. It just changes when they pay the tax, right? Because normally they would have got to depreciate that full build out as well. They just wouldn't have gotten to depreciate the entire full build out in year one. Now they would have had to drag it over a bunch of years. And so it would have affected their taxes year by year. Now it pulls it all into the present as opposed to pushing it into the future. And the consequence of this is that the earnings are going to look better today, but worse in the future. And I'm not sure how many investors are really sort of thinking that through and being aware, oh shoot, this is happening. But let's just be clear, what has that had an effect of? I think it's great. I think that from a policy standpoint, you probably do want to encourage companies to invest and engage in capital buildouts. That is probably a good idea for your country, et cetera. So don't reject, I don't think that I don't think it's a huge problem with them doing it. I think the problem that you run into is that it distorts the figures. Because whereas Google maybe would have spent $60 billion if they hadn't had the ability to do this full write-off, now they're like, cool, let's go crazy spending this because we're getting 100% write-off off it. It's really wonderful for us. Very, very good. And so this needs to be considered within the context of how it is affecting your GDP numbers. It is pulling a lot of investment into the present that boosts GDP, but because you're having to put out that cash, it's not necessarily sustainable in the long run, or at least it's not a normalized view compared to what you had in the past. If you just say, okay, previously we didn't have that, now we do have it, of course the numbers are going to look better. But the real question is, okay, what do the numbers look like year over year, 2 years into the future? What will that be? And so I can tell you, I did a video the other day talking about AI and kind of my views on AI and my bullish and bearish and things like this. I'm not particularly bullish that at this point in time, AI has made any meaningful dent in GDP. And nor do I actually think that it will in a very visible thing. Andrej Karpathy mentioned this in one of his interviews a while back, where he said he went and tried to look for, where was the internet boom in GDP? Where was the personal computer innovations in GDP? And you don't see it because it just kind of it's gradual. And so it gets kind of caught up in the exponential of growth that you're looking at. So you don't see this suddenly boom, here we go. And I would expect the same will be true here, right? Will you probably get some productivity boosts? Yes, you probably will get some productivity boosts. Will that be this massive sudden thing that you see in a sudden surge of GDP? No, you very likely will not. And that's fine. We need something to keep the exponential going, right? So exponentials over a long period of time they're very helpful. But I think it is important to be aware of how these numbers are calculated and what the factors are that are reflecting those numbers. And based on those things, what is it that you should expect? Now, it is certainly also true that in spite of or in addition to this tax benefit that is driving some of the CapEx, it is also true that companies are just spending a lot on CapEx because the opportunities are there to deploy capital that were not there historically. So these businesses, the hyperscalers, typically were making money through moving bits around as opposed to moving around atoms. And that was very useful for them from the standpoint of you could deploy relatively little capital and get relatively high returns. But what it also meant was these very cash-rich companies didn't really have a lot of ways to deploy money into build-outs aside from buying back their own shares or doing very large-scale acquisitions. And neither of those are particularly beneficial overall. So this is, I think, it's a generally good thing. And yes, that does contribute to the GDP increase. But it especially increases it because of the tax changes that have taken place. And on top of that, you have to factor in these changes in tariffs, driving down imports, and US dollar declines, driving down imports. And then simultaneously, of course, one effect that the US dollar dropping also does is it does help to some extent to increase exports by making US products a little bit more competitive compared to global products. So I hope that helps. I hope it's kind of a worthwhile overall analysis. If you have, again, questions or comments, put them below, point out some of the things that maybe I missed, and I will look forward to seeing you on the next video.